Hey everyone, so this section is on strong highs, weak lows, and strong lows and weak highs. What are they? How can we identify them? And how can we use this in our trading? This section actually ties in with market structure and expectational order flow. Now, in a bearish trend, which we're currently in here, my expectation is these highs are to stay intact and continue running these lows until the trend ends. And this idea is built by the 4-hour supply being respected. So even if we retrace here, even if we wick above it on the 15-minute or the 4-hour or whatever, as long as the 4-hour doesn't candle body close above that and it comes back down, it means this supply is holding. And if this supply is holding and we're in a bearish trend, my expectation is this low is going to get run. And the same thing applies on the opposite side of the spectrum. Here we have strong lows and weak highs. As long as demand is in control and we are in a bullish trend, my expectation is that these highs are going to keep running. And this is to continue until the highs are no longer being run and supply takes control. Now, as long as this demand is being respected and supplies are breaking, our expectation is that as soon as this pullback ends, that this high will be run. The next expectation is once this high is run, is we're going to get some sort of a pullback. And at this point, once this trend changes, we expect this 4-hour high to go. So that's kind of how we look at strong highs and weak highs, and strong lows and weak lows. Now, this is the 4-hour trend. So let's complicate things a bit now and dive into the 4-hour and the 15-minute combined. Now, it doesn't get a whole lot more complex, but we can kind of start using the 15-minute to build a narrative. So in this example here on the left, we are bearish, meaning we have strong highs and weak lows. As long as we remain bearish on the 4-hour, our expectation is going to be for the 4-hour highs to hold and the 4-hour lows to continue being run. Now, at this point here, we have something called a change of character. This is identified by the first 15-minute demand failing. So we swept the lows, or we swept the highs, I should say, and we swept the lows. Once this first demand fails, my expectation is that all of these demands are now weak, and the 4-hour downtrend took over and is to continue. So with that assumption, we can start assuming that all of these demands are going to keep going, that they're weak, and that all of these supply points are going to be strong because they're in line with 4-hour trend. So at some point, the 4-hour trend is going to put in a new low and it's going to need to pull back. We can usually identify the pullback starting with a change of character. You sweep the lows, you sweep the highs, something in here caused it, and we can start making an assumption that there's going to be some sort of a pullback. And again, we can use our little friend, the fib, pulled from the high of the impulse to the low of the impulse. And the idea is that we can start playing this pullback to at least a relative equilibrium territory. Once we get above this relative equilibrium, we're expecting the 4-hour bearish trend to take over. Now, once the first demand goes again, my expectation now is that the rest of these demands are going to start going. So now I can start building a narrative that the 4-hour bearish trend took over and this low is now weak and can become a target. And this continues on and on till the trend ends. At some point the impulse ends, this low goes, making this a strong high because it took out its low. So the job of a high is to run the low. The job of a low is to run the high. If this low fails to run this high, it's weak and will be run. And this is the battle between supply and demand. So query supply is in control. Now at some point we'll get down here and we'll need to pull back again. As soon as this supply fails and we have another change of character, we can once again play the pullback, and usually safely to relative equilibrium. The higher we get up in the leg, the less probables the buys become as the 4-hour is bearish. Eventually the pullback ends, the 4-hour trend takes over, and this demand is run. Once this demand is run, we can start making an assumption that this low is likely weak and will be run. And this can be confirmed by these 15-minute demands being run as we go along. Now, at some point, the 4-hour trend is going to end, and we will have a trend change. So here we have a strong high because it takes this low. We put in one more low. However, when we come up here, what ends up happening is this high fails to run the low, and as soon as we have a change of character in here and this high goes, we can start building a narrative that maybe there is a trend shift coming, and this trend shift's not fully confirmed till this high goes. Once this high goes and we have a 4-hour candle body close, this low now becomes strong. So if price did come down here, my expectation is for this demand to hold and price to continue on. Obviously the trend's not confirmed till we put in 2 highs, but we can start building a narrative that maybe the 4-hour trend is ending and changing for a bit. And this can usually be analyzed on the daily time frame as to where it could end and where it could pull back, because the market is fractal. Just like the 4-hour trend needs to pull back, the daily needs to pull back too. And all these time frames work together. Just like the daily needs to pull back, you're going to find that on the weekly at some point the daily is going to pull back. Now these are not required for day trading, but the 4-hour and the 15-minute is very imperative you get this right. So here we have a bullish scenario. By the way, if I went through this too fast, feel free to pause the video, read some of the infographics, and just kind of look at what I drew out. This is a pretty good concept to get a grasp of, especially considering it goes with expectational order flow, it goes with market structure, and it's going to go with the liquidity, the inducements, the changes of characters, and the inducements and liquidity theories, and everything just ties in together and helps us build that higher time frame narrative. So in the bullish trend, we expect the lows to stay intact and the highs to go, which means we expect these demands to maintain control and supplies to keep failing. Just like in the bearish trend, once the demand failed, we expected the pullback to be over, to go the other way. It's the same in a bullish trend. Once the first supply fails, my expectation now is that the rest of these supplies will all fail, including the 4-hour, and the week high will be run. Once again, at some point, this impulse needs to end. After it takes this high, we don't know when, but at some point it will pull back. And as soon as the first 15 demand fails, we can start shorting this back down, play the pullback. At some point the pullback ends and a 15 supply is going to fail and demand takes control. So now we expect the 4-hour trend to resume and this high to be run as it's weak. As this trend continues, it puts in another high. We expect another low. As the pullback happens, at some point this pullback will be over. And yes, we can definitely play the pullback. But at some point, the 15 supply will be run and the 4-hour trend will resume, making this high weak, and it's going to get run. Anytime a high fails to do its job and it does not take the low, it's weak. And in a bullish trend, it is a safe assumption to say that the highs are weak and the lows are strong until the trend changes. Now, at some point, something like this will happen where something reacts to something in here, and then all of a sudden supply holds and actually runs this low. We can now start assuming that, hey, maybe there is a trend change. And this will be fully confirmed once this low is run. Once this low is run, then you have a 4-hour candle body close. Remember, if it just wicks below, that is not a confirmation. We need that 4-hour candle body to close. A 4-hour trend does not end if a 15-minute candle body closed, because on the 4-hour, that's likely just a wick. We need to see the 4-hour close. Just like on the 15 trend, the 15 trend is not confirmed unless the 15 body closes. Meaning that if you have a 5-minute candle close past the 15-minute zone, that is not trend confirmation. The same time frame needs to break an area. So this will be confirmed once the 4-hour candle body closes, takes out this demand, puts in a new low. Once that happens, this now becomes a strong high. And my expectation is that this high will stay intact, and no matter what, that this supply will stay intact if price does return here. More than likely, price doesn't return to the extreme, depending which pair you're trading. This here is drawn on EU. EU's not known for coming back to the extremes, whereas if you get into the pound pairs or the gold, they like coming back to the extremes, and that's just pair characteristics. So don't be surprised if, if it comes back here and that holds. We never know at which point the market's going to react, so we don't guess. We don't just put trades anywhere. We wait for the market to show us that there is some sort of willingness to change direction. The first sign we have is always the change of character. You sweep the highs, you sweep the lows. Now we assume that the market's going to go in a different direction for a while. Now if you align this with your higher time frame narrative, you always know that in a bullish trend, the impulses up are going to be longer. The impulses down are going to be shorter. Until this happens, then the narrative switches. Obviously the trend is not confirmed until we put in two lows, but once this trend is confirmed, we can now make an assumption that the trends down are going to be longer than the pullbacks up because we are bearish. And as long as we're going down, we expect the highs to be respected and the lows to keep going. So this is the whole idea behind weak points and strong points, and these help us align ideas for where we want to take trades from. So if we have a point that is weak, we don't want to trade off that point. We want to trade off strong points. We want to target the weak points. So if you just had a simple trade idea here, you had a change of character, now you expect the trend to continue bullish. On the lower time frame, you'll likely find some sort of a pullback in here, and you could start trading up. Your first target would be the 15-minute week high. Your long-term target would be the 4-hour week high. And the same thing applies to a bearish trend. Anytime we have a trade idea going, the second this demand fails, we can make an assumption that at the bare minimum, as this is going down, we can at least run the 15-minute low or the next one. And the long-term target is, of course, the 4-hour. We want to have multiple areas of paying ourselves because the market's not guaranteed. This is a picture perfect scenario. In real live market, as most of you know, there's nothing to stop the market from doing this, and then, you know, and the market can move sideways. So we always got to ensure we have ways for getting paid. So if you're targeting the 4-hour points, that's great. Those are great targets, but we need to pay ourselves somewhere before that if for some reason the trend never made it here and just reversed. We want to know that we have no risk in the market and that we've paid ourselves. We will talk more about this topic in the trade management section towards the end of the course. Right now, I need you to take this concept, absorb it. This is going to help you build a really good narrative. If you don't understand this concept, I suggest you rewatch this, and I would get this concept, market structure, and expectation order flow down before anything. If you had to get one thing right out of this whole course, market structure is 1 and expectation order flow is number 2. This would be number 3. The other concepts, yes, they are important, but market structure is king. So if you are going to put the most effort into one thing, it needs to be market structure. And everything else will just tie into that. It's always good to know which direction you should be trading. And if you understand market structure, more often than not, you will end up on the right side of the market. And that's what we're all about, is being on the right side of the market as often as possible. So I'm going to cut this video here, and what we're going to do is go on the actual charts, and we're going to talk about strong points and weak points and what our expectation is and why, and maybe this concept will make a little more sense to you guys. I will see you guys in the next video.